Let's kick this explainer off. Teradyne is basically acting as the essential picks and shovels of the massive AI gold rush. But, the big question is the stock actually a buy right now? Today, we are putting their jaw-dropping Q1 2026 earnings to the ultimate test. We're going to run their numbers through the legendary investment frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, and our own rigorous DCF models to see if the underlying value matches the hype. Okay, you've got to look at the sheer scale of this top-line beat. Teradyne just posted an all-time record revenue of $1.282 billion for the first quarter of 2026. To really put that into perspective, that is up a staggering 87% year over year. I mean, they didn't just edge past expectations, they absolutely shattered them, completely blowing past their previous high watermark. And the catalyst behind this explosion? It's pretty clear-cut. As CEO Greg Smith pointed out, nearly 70% of this revenue is now directly tied to the surging demand for AI-related test solutions. Just to frame that, it's a massive jump from the 60% they saw just one quarter prior. So, this transition from a mobile-heavy testing portfolio to an AI-dominant one, it isn't just some future roadmap for Teradyne. It is literally happening right now.
So here is our roadmap for today's deep dive. We're going to unpack this record quarter, map out their whole AI strategy, and then really dig into the valuation by running these metrics through our guru models, which includes a head-to-head matchup with KLA Corp and a full DCF valuation.
Let's jump right into the record-breaking quarter and take a look at this staggering financial growth. Now, while it's super impressive that revenue jumped from $686 million in Q1 2025 to over $1.28 billion today, the real mic drop moment here is that Teradyne blew past their consumer-driven mobile peak from way back in mid-2021 by a full $200 million. And get this, at the exact same time, their non-GAAP earnings per share jumped 241% year over year to $2.56. That is exactly the kind of robust earnings consistency and sheer earning power that hardcore value investors look for. And this is where things get really interesting. Operating margins soared to a record 36.88%. If we look at this through the Warren Buffett lens, this is exactly where Teradyne's economic moat is just beaming. A 1,926 basis point surge year over year proves they have incredible pricing power in high-margin compute and memory testing. You combine that with their highly manageable debt, and man, they are generating the exact kind of stellar return on equity and owner earnings that Buffett dreams of. Moving right along, let's explore how they are riding these AI waves with their wafer-to-AI data center strategy. So Teradyne actually views the AI boom in three superimposed waves. Wave 1, which drove all that massive 2025 spending, was all about building out general-purpose AI data centers. Now, sitting here in 2026, we're right in the thick of Wave 2, which is hyper-focused on silicon optimized for inference at scale, basically putting these massive models to work efficiently. And finally, Wave 3 is still on the horizon, edge and physical AI. Think self-driving cars and advanced robotics. Teradyne is actively positioning their testing infrastructure as the absolutely essential foundation for every single one of these phases, happily selling the shovels to everyone digging for digital gold.
Let's shift gears slightly and look at how their semi-test and robotics divisions are firing on all cylinders to make this happen.
The Semiconductor Test segment just shattered the $1 billion threshold for the very first time, landing at a cool $1.1 billion. The lion's share of this? It's System on a Chip, or SoC testing, bringing in $882 million. And crucially, about 75% of that SoC revenue is specifically compute-related. We're also seeing fantastic memory testing revenues of $203 million, completely driven by the intense need for high-bandwidth memory, or HBM, in AI applications. And all of this growth is happening even while their traditional mobile markets are basically staying flat. Which actually brings us perfectly to the Peter Lynch lens. Lynch absolutely loved a good turnaround story and uncovering hidden fast growers. Well, despite a really rocky 2025, their robotics division just posted $91 million in revenue. That's up 32% year over year, delivering its fourth consecutive quarter of sequential growth. If we calculate a PEG ratio based on this revived growth trajectory, Teradyne basically transforms from a slow-growing stalwart into a highly compelling asset play with a rapidly growing appendage. Now, to lock in this dominance across the board, Teradyne just launched two major new platforms. First up is the Photon 100, which is built for testing silicon photonics and co-packaged optics, a market they estimate could expand their total addressable market by $300 to $700 million annually in the midterm. The second is Omics, designed for super complex server board testing. As AI data centers scale up, catching defects early is non-negotiable. and Teradyne is supplying the exact tools the industry desperately needs to do it.
Okay, let's talk financial health and buybacks, and how they are returning serious value to shareholders. Let's run these financials through the Benjamin Graham lens. Graham's defensive investor checklist demands a rock-solid financial condition, and honestly, Teradyne passes with flying colors. By shrinking their diluted share count by 13.9% over the last 5 years and completely dwarfing their stock-based compensation by 33 times, they are actively and aggressively increasing intrinsic value per share. If you run Graham's intrinsic value formula against these bolstered EPS numbers, it gives us a much wider margin of safety than you would usually ever see in a high-flying tech stock.
Next up, let's do a direct competitor matchup, Teradyne versus KLA Corp. Which AI infrastructure play is actually stronger right now?
So, using a comparable company analysis model, the valuation gap here is glaring. Teradyne is currently trading at an 11.24x forward price-to-sales multiple, compared to KLA's much steeper 17.47x. And when you factor in Teradyne's 17% average earnings surprise history versus KLA's 4%, our relative value model clearly favors Teradyne. This is especially true right now since KLA is battling some heavier export control and tariff uncertainties.
We do have to look at the other side of the coin, though. Let's dig into analyst forecasts and the risks of navigating this lumpy growth.
Look, every solid valuation model requires a serious assessment of risk, and management has actually flagged a major one for us: deep customer concentration. Right now, Teradyne has 2 specifying customers and 1 purchasing customer that each account for more than 10% of total revenue. Because they're servicing a small handful of massive tech giants building custom silicon, these order cycles can be highly unpredictable. Management specifically warned us about short-term demand peaks and valleys, and they noted they have somewhat limited visibility into the second half of the year.
But despite those concentration risks, the institutional outlook is still incredibly bullish, setting an average price target of $453.60. And check this out, if we build a base case DCF valuation, modeling out their 34% forecasted earnings growth and factoring in a standard weighted average cost of capital, along with a conservative terminal growth rate based on that Wave 3 AI adoption we talked about, our fair value per share actually aligns really closely with this 40% upside potential. So let's synthesize all of this into a final recommendation. Buffett would absolutely love the moat and the juicy margins. Lynch would buy into the robotics turnaround story. Graham would deeply appreciate the aggressive buybacks padding the intrinsic value. And our DCF models, they show a very clear path to a 40% upside. Yes, lumpy order cycles pose a very real short-term risk, but Teradyne's fundamental dominance, from the wafer right to the data center, earns this stock a solid buy rating at current levels. Thanks for joining me on this explainer, and keep learning.